Hello, this is Coach Mike from winningstockcoach.com. Going to get started with my market overview. After, that dreaded day, August 24th, we kind of got into some weird trading patterns and a lot of doubt created. Simply, if you followed what the media said or even what the stocks were doing at that time, it wasn't too pretty until just the past few weeks coming up out of that. And as you can actually see here on the chart I'm showing here for the SPX, this is a weekly chart. We actually came back to that same consolidation range we had been in from February clear until the end of August. And we're sitting in that zone right now. Now, to make things really, really simple, I simply want to state, just based on a couple technical patterns you can see here. Now, on the weekly chart, it's not as easy to see, but you see these two what's called wicks down here creating essentially a double bottom. Now, if I change this over to a daily chart, you see that double bottom become a very, very prevalent pattern that's easy to identify. Now, there's also a very, very common technical pattern that's extremely bullish that many people are familiar with. It's called a W pattern, simply enough. It starts with a drop that goes up to a lower high, to where the subsequent drop is around the same value, creating what's called a double bottom. Now, at first, this leads into just a consolidation range where you trade targeting that prior top point. But it's from that breakout that you have a pretty bullish momentum trade pattern, the W, at which time the center line of the W, which is the highest close in that center point here, 1995.31, becomes the support level on the W, where that first breakout trade, you target the highest close after the start of the fall. Now, to do that, we'd have to start looking through all of this, and we'd see, this was the last high point back here on July 20th. The start of the fall would have been that morning of the 21st of July. So the highest close since that fall had started, 21.1921. And as you can see with the high there, not quite, but almost there. So very close that you'd have to say, dang, that's what it did. The W broke out, created the momentum trade, and hit a W pattern target. Now, there's two places to buy a W. The first is on the breakout from the center point. And the second is when it retests that center point. And if you've got any experience trading the W pattern, you actually find that what I just said is so constantly reoccurring in your own mind, not just to buy the breakout of the center point, but to buy the retest of it, because we not always, but nearly always see with the W pattern, the momentum trade on the breakout, then the retest, and from that retest point, should you get a positive move from it, an opportunity that is then actually very easy to trade, from which the risk to reward ratio is greatly in your favor. Now, that being said, I want to switch over to that weekly chart again, and I want to point out something else. That something else is, sometimes those W's don't just stop at that point I mentioned. And therefore, we do have a consolidation range with a resistance point at 21.2664. Now, if you follow my videos over the course of the past few years, you'd find that these Fibonacci extension lines are something I use a lot, and they've actually been pretty accurate, within about 0.5% for most of the market moves. And if that's the case, right now you have to be viewing that prior resistance point as, to make it real simple, there's a reason it fell from there before. Whatever that reason might be, there's a reason it didn't break it before. And therefore, being at that point, there's a reason it might not break it again. But should it break that point at 21.2664, That point then becomes your support slash stop out point for a run that seems to me would go up to about this 2187.07. Now that sounds all good and real simple, but how do you trade something like that? In reality, after this big of a move up, it would be hard to continue with a long trade or to enter a long trade. Continuing with it wouldn't be that hard, but to enter a new long trade on a breakout so close to the target. In reality, I think the best way to do that would be much smaller than normal position sizes, and in trading options that expire 2 to 4 weeks from the date that you're buying them. Much smaller positions than normal, and options that would expire 2 to 4 weeks from the date you're buying them, to be trading into that 2181.07. Now that doesn't just mean for the SPX, that means bullish trades on positive beta stocks in general. The other thing I want to look for, and I want to make reference to, is really, really simple here. I'm going to bring over another daily chart, or another chart that's a daily. And on this daily chart, you'll see this yellow line. This line is an 8 simple moving average. Very, very simple. It's a shorter term moving average that takes the average of the last 8 daily candles to give you your value and helps you with establishing of a short-term trend. Really, you can see that even back over here as that curled down. You see it curled down here, and this was really, the first kind of bad day on it, and then it gave you another chance the next day to maybe get in some shorts. And as long as that line was going down, you had those opportunities to make money. When it went up, you might not have caught the low, but you had opportunities to make money. And back down again, up again, and here we are over in the current time, and it is showing you something that has been pretty repetitive. You've had a few times you've come just below that 8 simple moving average. But the thing to really understand is getting that 8 simple moving average to curl back downwards. Now you could say, man, it could drop really far before it curls down, and that is true. That is true, and that's why I'm going to end this discussion with a way to work around that doesn't put yourself in as much risk. But what we're really looking for to play into the retest of that W would be that downwards curl on the 8 simple moving average. Basically put, we want it to do something different than it's been doing over the past month. It's been moving upwards and staying above the 8 simple moving average. We want to see something different before we say, oh, let's just go short. That being said, because there's that risk that it could drop quite a bit before it actually curled that, or it could do what it's done like over here where it drops quite a bit, but before that moving average curls, it comes back into the moving average and then starts dropping again. And you can actually see that happened very frequently on the downwards moves as it curled downwards. And it gave you those opportunities. So that's going to be our confirmation. But at the same time, any close of a day that we get below that 8 simple moving average, you can simply take a half size position in a short, to which your target point is right here at this line. And I'm going to change that line to green because it is a swing high point. And we'd be targeting down into this point. Now, the way we would want to trade that is with December monthly options or even January monthlies to give us the time to make that move. Now, you can see here by my expectation, it's not for a lower low, but I'll be the first to tell you I wouldn't be surprised if we got down lower than that W point. But the point I'm making is we cannot target below that W retest point simply because of the probabilities of this very pattern and the bullishness it possesses. Now, the final thing I want to kind of make note of and discuss, and normally I like to keep this video to simply discussing technical aspects of a chart. But for this next point I'm going to make, I simply want to discuss the technical aspect of where it is right now in relation to where it was up here. Now, for quite a while now, different economists have debated or guessed when they thought the Fed would finally raise interest rates. And we've seen those projected dates change on almost a daily basis. For most of this past year, many traders were almost just, I mean, it was like, Janet Yellen, please just tell us when you might do it. Quit being so condescending or misleading. Just tell us when you might do it. If you guys remember back to a press conference Janet Yellen did from Cleveland, Ohio in July, she actually had stated that her words were, the market needs, not is ready for, needs, N-E-E-D-S, a rate hike. And the economy needs a raise in the interest rates. But at that time, the pending issues with Greece and the European Union were one of the many things, but really spotlighted as a major thing as to why those rates didn't increase. As we got into August, some fears for China presented themselves, and then we got this big fall that was kind of blamed on China in general. And we had another reason that the rates didn't increase. The one little bit of food for thought I want to present to you is the past month's up move has actually been on pretty low volume. It's almost seemed manipulated to a point. And would it not be kind of funny, I guess, to look back months from now and say, wow, the markets needed a rate hike. The economy needed a rate hike back in July. So they just took the markets back up to where it was in July so they could do it. Now, with that being said, I don't want you to just go short everything expecting some sort of crazy crash. I want you to trade smart. I want you to understand the bullishness of that W pattern and that support point we now have to hold, which would not be a lower low. In fact, it would be a higher low, and a bounce from there would present bullish trading long opportunities. That point being 1995.31. I want you to also understand that should we break above 21.26.64, if there's a trade you want to make, it needs to be with using that 21.26.64 as your support / stop out, with this 21.81.07 as your target point. But I want you to keep that last little tidbit just in the back of your mind. Because should that W point that I mentioned there about 1995 fail, I want you to watch really, really closely about 1865. And from 1865, I want you to watch for the first possible chance of a bounce, because they won't make it that easy. And exit those shorts should you get any bounce around, 1865, maybe down to 1850. And that subsequent bounce would be where you go a little longer term in your shorts. Look at the jobs reports. There's an increasing number of new jobless claims. There is a decreasing number in new jobs created. It's happened consecutively for a couple quarters now. At this point, S&P 500 stocks have had the highest percentage in a few years of stocks missing their EPS estimates and or revenue estimates. I want you to think back over the past 1 to 6 months. Companies like Microsoft and JP Morgan and Goldman Sachs and many, many others that have announced closures and job cuts and anything they could do to make those numbers meet that bottom line. And some of them still coming up short on their earnings. And remember that and stay thinking of that so that you can plan ahead, not act right now on a plan ahead, but plan for the time that the charts may become bearish. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in this upcoming trading week. And for any veterans out there, I want to thank you for your service. I myself am a veteran, and we got Veterans Day coming up on Wednesday. And just want to thank my brothers and sisters in arms for their service and what they sacrificed for the country. God bless. Good luck. Have a great evening.